Now moving on to global financial management, which is the final part of chunk 4 of financial management in the Year 12 Business Studies course, and focuses on things such as exchange rates, interest rates, hedging, derivatives, and then methods of international payment. So this video will start with exchange rates and interest rates, and with hedging and derivatives, and then the next video will focus on methods of international payment. So in terms of global financial management, with globalization and the spread of businesses globally, there is now an increasing emphasis on the need to effectively control those things which are within your control from a global financial management perspective. And that might mean things such as purchasing inventory from overseas and dealing with exchange rate fluctuations. It might mean dealing with suppliers overseas and how do we effectively pay them securely and safely. It might mean selling to customers overseas and how do we make sure that we are paid effectively and receive payment for those in our currency at a currency rate that has been managed and is effective. Interest rates and exchange rates really are the two of the biggest challenges in terms of global financial management, because both of those are constantly changing, and particularly for a business like Qantas that's dealing significantly overseas and is constantly having to change its currency back to Australian dollars, that provides a really tough challenge, and one that needs to be consistently managed and appropriately managed so the business can achieve the profits that it is hoping to achieve. So firstly, exchange rates. They're one of the many challenges for global financial managers. Given most international trade involves exchanging the currency of one currency for another, there's an additional level of risk and complexity in relation to these transactions. And the other thing is that exchange rates are constantly changing. You watch the news at night, you can see that every second of every day the exchange rate is changing globally, and the global currency markets are so significant these days. I think there's $1 trillion of global currencies traded every day, and I think the Australian dollar is traded to about $1 billion worth of Australian dollars is traded globally on global money markets. So as such, there's significant complexity, and it's a really important part of any business to ensure that they are effectively managing those elements of their global business. Exchange rate, what do we mean by an exchange rate? Well, it's one currency quoted in the context of another. So for example, $1 Australian dollar is equal to buying $1.05 US cents. At the moment, I think it's $1 Australian dollar buying roughly 71 US cents. So that means you need to give it $1 Australian dollar to get 71 US cents in return. You can see there a bit of a graph which is really just showing you the volatility and the significant movements in currencies of your three major currencies there against the Australian dollar: the yen, so the Chinese currency, the euro, and the US dollar. And you can see the level of change and volatility in those currencies since the early 1980s. So in an effort to reduce these risks in terms of exchange rates and give some sort of certainty in what is a very uncertain market, managers might look to do things such as hedging to minimize the risk of significant exchange rate fluctuations having impact ultimately on their profitability. But the problem is that process it is complex and it can be quite expensive. It's helpful to look at exchange rates from the perspective of Qantas to make it easier to understand. So Qantas is exposed heavily to fluctuations in exchange rate, and that's because a lot of their purchases, such as jet fuel, interest payments, aircraft leasing payments, and capital expenditure, are predominantly denominated in US dollars, so they're not undertaking those transactions in Australian dollars. I think Qantas says about 38% of their revenue is also generated from overseas, so in other currencies, which then needs to be exchanged back to Australian dollars because they are an Australian business and they're denominated in Australia. So to put into some context, well, what does it mean if the Australian dollar appreciates? So if the Australian dollar gets stronger against the US dollar, for example, so that would mean it going from, for example, $1 Australian dollar buying 71 US cents to $1 Australian dollar buying 80 US cents. That is an appreciating currency. An increase in the value of the Australian dollar reduces the price Qantas pays for those things it's purchasing in other currencies. Because our currency has become stronger, that means it's costing them less to buy things such as jet fuel, such as paying interest rates in another currency. On the other side, though, it does mean Australians are more likely to travel overseas, but one of their major markets, overseas tourists, are less likely to travel to Australia because they're not going to get as good a exchange rate for their currency when they change it back to Australian dollars. However, for a depreciating Australian currency, so a falling Australian dollar against another currency, the opposite is true. It increases the price Qantas pays for those items such as fuel, lease payments, interest payments, and that means Australians are less likely to travel overseas, but overseas people are more likely to come to Australia because their currency is going to buy more Australian dollars, which will make travelling for them cheaper. Overseas interest rates are often lower than they are in Australia, so therefore many organisations will seek to borrow overseas, but they need to be wary about those fluctuations in global interest rates. There is also the additional risk that if you borrow money in another currency, you will generally need to swap that currency or exchange it into your currency. So there is an added layer of risk there in the context of interest rates overseas if you should choose to borrow money in another market, that it needs to be changed back into your currency. And that's my point I've just made, and that adds that extra layer of complexity. So for that reason, companies or organisations might choose to hedge some of their risk. What do we mean by hedging? That's undertaking some sort of strategy to reduce the risk associated with a fluctuation in exchange rates or in commodity prices, such as iron ore or interest rates. For example, a business can purchase financial instruments such as a derivative, we'll look at derivatives in a moment, to lock in exchange rates or the price of commodities at today's rate to guard against an adverse price fluctuation. Now, there is a cost associated with that, but it is minimising the risk associated with those potential fluctuations. There's an example for you just to have a look at. If you read through from step 1 to 5, you can see that an example of hedging for a farmer who's looking to sell wheat in the future. And by hedging or locking in the price today for the price in the future, they are dramatically reducing their risk. So what does Qantas do in the context of hedging? Qantas uses a range of derivatives to hedge future fuel prices and future interest payments. For example, Qantas uses a thing called a forward cover to exchange one currency for another at a date in the future at a predetermined exchange rate. Now, there's a cost involved in undertaking that forward cover, but for Qantas, that cost may well be justified because it's giving them surety of exchange rate in the future. Qantas said that in early 2016 that they had hedged 95% of their fuel needs through the use of options contracts, so that they knew already what the price of fuel would be for the remainder of 2016 because they had locked those prices in for a fee, but it was giving them surety of knowing what the cost of their fuel was going to be going forward. So just to put some clarity around derivatives, they're instruments that businesses buy to give them financial exposure to the performance of an asset without having to buy the asset itself. So derivatives are very complex, and for the purposes of this course, you just need to understand that derivatives are a special type of contract, so a financial contract, which exposes a business to the performance of an asset without having to buy the asset itself. And they can be used to shut off, minimize, or eliminate risk and uncertainty. And there are three main types of derivatives. Forward exchange contracts, where you agree to exchange something in the future at a predetermined price with another party. An options contract, which gives the buyer, so when we were talking about Qantas before, they were the buyer, the option but the obligation, but not the right, the right but not the obligation to buy or sell foreign currency or some other commodity, it could be, at some time in the future for a cost, but it's giving you some option. And lastly, a swap contract where you agree to swap one currency for another and then unwind that transaction by swapping back. So for example, Qantas might choose to swap 50 million Aussie dollars for US dollars now, and then in 3 months' time reverse that transaction and swap the currency back. Again, cost involved, but it could be beneficial to both parties if both parties want the currency of the other party in that particular contract. That's it in terms of the first part of global financial management, and the next video will focus on methods of international payment.